right, everybody, welcome to another episode of the Building Your Own Economy Show. Today's guest, Mr. Bill Faeth, the creator of super properties. He is the guru, if you will, and I mean that really, not like those fake guys out there. This guy knows what he's doing with short-term rentals. In today's discussion, we're going to talk about short-term rentals, cash flow versus tax benefits, because you guys know I love the tax benefits, but you got to hear this because he's got a very unique perspective, as well as his upcoming conference where if you're in the short-term rental space or you want to get into the short-term rental space, this might be a conference you want to go to, and so much more, even about our wives. And there's just so much in this. I promise you don't want to miss this episode. So help me welcome my guest, Mr. Bill Faeth.
Thanks for having me, David. I'm excited to be here and talk about taxes and cash flow and real estate.
All right, everybody, help me welcome my guest today, Bill Faeth. Bill, how are you, man?
I'm doing awesome. Thanks for having me, David.
Bill, I hear a lot of great things about you, man. You are the short-term rental dude. Am I correct on that?
That is one of my average talents.
Average talents. Okay, what's the main talent? What's your best talent?
I think, honestly, probably building a super life, to be honest with you. Short-term rentals and real estate investing is just a little part of that. I would say it used to be golf, but, Tiger Woods kind of put me in the grave about 25 years ago, and I've never been able to dig my way out.
So what is it that drives you today? What do you focus on every single day?
Every single day, I've achieved what I call building a super life, and it's something that I share with. I have 30,000 students with them, and on my socials, I just have I grew up, David, in a family of educators. My grandparents were educators. My mom was a teacher back in the early and mid 80s. One of those ladies that probably never made more than 30 grand a year in her life. And I just grew up wanting to really self-educate myself, which is what I've done over my last 50 years, but also then to be able to share that in abundance with other people. That's really what drives me. It starts with my two young girls at home. And, focusing, I've got a 17-year-old and a 14-year-old, and then it goes out into kind of my public life as well.
What do you teach your 30,000 students?
I teach them really about investing, about financial literacy. I have quite a few professionals, doctors, anesthesiologists, dentists that don't get a lot of that. They're typically not the most financially literate when it comes to wealth building or, investing. So I do teach them about short-term rentals. I still believe that short-term rentals, even today, as we're recording, are still the number one asset class to invest into if you know what you're doing. If you're just buying and being passive with it, then it's probably not, because you're buying an average 3-2 in an average market in an average location, and it's not the best. But when you do things, what I call maxing out, and not from a buyer perspective, but I believe in maxing out my life. I think I learned that from my grandfather, who kind of helped me achieve. I got a full ride golf scholarship to UCLA, played professional golf. I've maxed out probably 15 to 16 of my startups of the 29 that I've done. And now I'm teaching them to do the same thing. So we kind of have to, the number one thing for me is we have to determine what that outcome is, right? So if we can determine what the outcome is and then be able to keep score with that, then we have that end game in mind. We can distill those decisions down to educated, financially driven, and personally driven decisions on a daily basis. That's really the 30,000-foot view of how I teach people to re-architect their lives.
Do you focus on, it sounds like what it is, it's like a framework, maybe like a value system by which you make decisions. Is that more in line with what I heard?
Yeah, so I learned this in 2015 from one of my mentors who's now retired and an angel investor. And one of the big things is, number one, everybody wants to have financial freedom, and then just about everybody wants to travel the world when they're retired, right? Well, we can't keep score with that. That doesn't help us make sound decisions every single day. So what he taught me is, number one, you got to be able to keep score. So, Bill, what date do you want to retire? I'm 50. It used to be that I was going to retire at 60. Well, there also has to be a life plan that goes along with that, right? So financially, I'm there today. I hit my financial goals at 60 when I was 48. So I'm good as long as I sustain. but there's some life events that have to transpire in my life before I can officially retire. So I'm about 65% of the way retired today, but I have my youngest daughter of 2 is a freshman in high school. I can't really retire with, and I should say we, meaning my wife and myself, because we are best friends, business partners, husband, wife, lovers, parents, everything together. And the big thing, David, is John Baird and that mentor unified us. And most spouses think they're unified, but they're really not unless you go through an exercise of documenting what does retirement mean to you. And take that financial freedom and let's give that a deeper definition. So at the time, I was making about $300,000 a year. I'm like, I want to make $500,000 a year. And okay, well, when do you want to retire? I want to retire at 60. It's just an arbitrary number. I'm 50 today. Well, how much debt are you comfortable with? I didn't know at that time. Well, how are you going to get there? Are you going to do stocks, Bitcoin, real estate? Kind of deciphering all these things down to where I really had a really well-rounded business plan for my life professionally and with my wife. And this goes all the way down to the audits. My wife and I have on Fridays, it's called Faeth Friday. My social media manager years ago branded that, but we meet from 12 to 4 to audit the previous 7 days. And what I mean by that is we're auditing, we have an SLA, a service level agreement that John had to sign between the two of us. Once we had documented everything. So did we have sex 3 times or more? Because it's in our contract that we have to be sexually intimate at least 3 times a week. Were we present 90% of the time with our kids, right? So then we go to our 2 daughters and we say, hey, they have like 5 or 6 indicators that they rank us on a scale of 1 to 10 on Friday night when we get back from Faith Friday. Usually we'll go to lunch, we'll have a bottle of wine, a couple of glasses, we'll go through our financials, we'll look at what we're going to try to accomplish over the next week, and we just have this fun, intimate afternoon together, but it's also driven to make sure that we're on pace, we're on track, and we're still moving towards our goals.
That's very interesting. Who did you say taught you this formula, this framework?
A gentleman named John Baird. So I was in EO, David, if you've heard of the Entrepreneurs Organization. Got recruited into it, put into a forum, had a less than stellar experience. Not to talk negative about EO. I love the program, but I think there was one fundamental flaw in the forum, in the group of 9 guys. There were 4 overachievers and 5, I don't want to call them underachievers, but just type B guys that were kind of walking through life, right? And after about 6.5 months and investing 8 to 10 hours a month with them, I basically just decided I'm not going to be in the group anymore, and I'm going to go start my own group because I want to be around people that are looking to max out, people that aren't just going through the motions, that are looking to achieve their dreams, and let's convert those. Let's execute on those. Don't show up 5 minutes late. Don't show up without your profit and loss and your business plan, and just you got to give more than you expect to receive. And there were takers that were in that group. So when I left, 2 guys came with me. We ended up recruiting 4 others. We started with 7 people. And one of the gentlemen that came into that group with me knew this gentleman, John, who was a 2-time Fortune 500 CEO. He had became an angel investor, done 3 or 4 startups. He was older than us, worth probably a couple $100 million at the time. And we hired him to come in and be our director, be our chairman. And the first thing he did when he walked in, he's all, you guys are my direct reports. I know none of you have had a job ever, so you've always been at the top of the org chart, the top of the food chain. You guys report to me. And he implemented like a monthly check-in. We would meet once a month for like 6-7 hours and have dinner. And he implemented a mid-month check-in. We had to have a phone call with him to make sure that we're prepared for the next meeting, make sure we're executing on our goals. But the big thing that happened in that first meeting is I know you guys want to be just like me. We're all like, yeah, we want to be worth $200 million. It'd be cool to have, some of the companies that you built be a Fortune 500 CEO. And he said, no, you don't. He said, you know what? I'm on my 4th wife. I've been divorced 3 times. He's I haven't spoken to my oldest son for, a couple of years, and he just became the president of a bank. Basically, everything in life was sacrificed in the personal side to ascend that corporate ladder, to ascend that entrepreneurial ladder. And he said, we're getting your guys' shit straight right off the bat. Before we even look at anybody's balance sheet, before we look at anybody's plans. And that's where it started. And it took us about 3 months to go through re-architecting our lives with that desired outcome. And I'll tell you, every single of those 7 guys, we were all Christians. None of us had been divorced. Many of us had been married for 20 years plus. Every single person in that group, the smallest business was about $4.5 million at the time. But we found none of us were completely aligned with our spouse. And that's what changed. I'd say probably 7 of the 9 guys that I'm still in contact with today that went through that exercise in 2015, 8 years ago, got aligned and still aligned. There was a gentleman in there that had a pharmaceutical company that literally went from 2 million to 32 million in about 4 years. And he attributes all of it to that alignment and the restructure of architecting our lives. So I'm a big believer that we all have the ability to architect our outcomes. I think people use the word manifest, David, and they think about, if I think about it and I self-talk myself, we can manifest it. I look at architecting means we actually have to execute physical attributes to be able to make that happen.
By the way, I 100% would agree with you. It's interesting because one of my mentors early on talked to me about forming a board. And this was probably around 2013, 2014 for me. And he was a very successful businessman, or kind of businessman, more so in the C-level world of major organizations. He retired in 2013 from Citibank, managing a $200 billion portfolio, very successful guy. And when he coached me, and this was just like kind of mentorship, he said, you need a board, David. You got to have a board of directors in your life. And he's like, you need a good banker, you need a good lawyer, you need a good accountant, you need a good, what did he tell me? I think it was just the 3 at the time, because I've added, in fact, I'm kind of writing a new book and that's part of it. But the one thing he never said to me, interesting enough, was I thought was number 1, which is your spouse. Like, you got to have a partner, right? And obviously he didn't say God or faith, but he did say faith. I believe you have to have faith, not Bill Faith, but maybe Bill Faith. But like have spirituality, which is either a pastor or a father, whatever that is for you, right? You've got to have somebody to go to and counsel. And I added in there, you needed a physician or a clinician. Like, you need these people in your lives to make good decisions. But I always thought my wife has to be the number 1 in that, because if you're not in alignment at home, every time you go home, you're frustrated, you're pissed off, and you can't share that with them because they don't understand it or don't know or don't care, or it just doesn't work. And so, interesting enough, just this weekend, I was with my wife. I took her to an event with me. She goes to all the events with me, by the way. I didn't even take her. We go together. But the guy who was running the event was just like, if you brought your wife here, it was just coincidence. He goes, if you brought your wife here, you're on the right page. Because very few people will go to events and take their wives or take their significant others. Very few people will deliver the same content. And I thought, I mean, my wife and I aren't perfect, but every day we're always trying to find a better way to align. Because if we're not aligned, I know what you're saying. It's horrible, because for the first few years of our marriage, we weren't. And today I feel like we're more aligned than ever before in our goals, our missions, our values. So you saying that just reaffirmed it. And that's why I asked who, because that's pretty interesting, man. That's amazing, by the way. Amazing. Congratulations on figuring that out and taking action on it. It's an amazing story.
Well, I really, really appreciate it. And as you become more public with your life too, that it becomes even more challenging, for especially my wife, who's always been behind me, and she's always felt like she's kind of been in my shadow. We met when I was playing professional golf, and then it's just kind of ascended through the successes, and then I've become a more public persona. And I pulled her to the front, very similar, like you go to your events with my wife. I mean, like, she, in the real estate world, she's my designer. So we kind of go side by side, because in the short-term rental space, design is a critical, element to that. It's interesting what you say about kind of building your board. In the short-term rental space, I built the super team, and I have the best attorney. I have the best CPA to take advantage of all the tax loopholes that we have in investing into short-term rentals. I have the best real estate agent. I have not the banker, but we call him the bank whisperer. So the guy that gets your financials prepared and helps you get the most incredible terms in loans. I've got the best marketer. I've got the best data analyst. So there's this team of 8, myself included, that makes up the super team. And those are the giants that I stand on their shoulders. They stand on mine. And I agree. I think we all need a super team. We all need a board, especially if we want to ascend and max out to that highest level.
Well, that's interesting because, very people think that way. But now that you brought this up, okay, let's talk about short-term rentals. So short-term rentals. I don't have any short-term rentals. I am big in real estate. I've got multifamily, small and large. I've got commercial. I've got single family. I've got a lot of real estate. I haven't wanted to get into short-term rentals because of the work, right? It's kind of my deal. Like I'm not trying to be, and by the way, I meet all the loopholes. So we could talk about the loopholes for short-term rental in just a minute, but I already meet the status and things to benefit from the tax savings that I need. So I don't necessarily have to go the short-term route. And so I just haven't. But for those who are out there, what's the number one driver? But is it just revenue for the people that you coach? Is it just looking for the highest return on investment? What are they looking for when they're investing in short-term rentals? Or what are you looking for?
Honestly, I think a lot of people have gotten into it for the wrong reasons. They've gotten into it just for the tax advantages, for the cost segregation benefits, and when they're high W-2 income earners or entrepreneurs. I look at every investment as I'm starting a new business. So I look at it a little bit differently. I kind of bring my history of entrepreneurship, and I've built a couple of decent-sized companies in my career. And so I apply that when I'm underwriting a property. So for me, it's cash flow first, it's, appreciation second, and then it's tax benefit third. And if I'm going to prioritize that, literally 60% for me, is going to be cash flow. About 25% of that's going to be appreciation, and about 15% of that is going to be cost segregation. But I think where people that aren't really in the know kind of make the fundamental mistake is they hear people like me talk about, hey, I bought $1 million property, I put 20% down, $200,000, and I got a $200,000 or $250,000 cost seg benefit, but they don't really understand how that works and some of the ramifications that go along with it. So people go and they buy based on the cost seg benefit, a tax benefit, to accelerate the depreciation first. And then what happens is they might get a pretty decent tax benefit in year number one, but then they have a non-cash flowing asset, over the next 3 years, 5 years. And if they decide to sell, the IRS is going to recapture that accelerated depreciation. So for me, it's really cash flow. I mean, even in today's market, I build what I call super properties. And a lot of people think, oh, well, that's got to be a multi-million-dollar property. It's not the way that it works. I mean, it's just maxing out, I'll use that term again, maxing out a property, whether it's a 2-bedroom or a 10-bedroom home, boutique hotel. I'm looking at 6 cabins right at the entrance to a national park right now, multifamily, to be able to purchase. So I have to look at kind of that after purchase value that I can add to attract the right buyer persona, the right ideal guest to come and stay. And when I do, even in today's climate, I'm still getting 6 to 7x long-term rental. And I'm still getting about 2.5 to 3, sometimes 3.5 times, depending on market, what I would do is a midterm rental, right? The one thing that, depending on, a lot of people think that Airbnb or short-term rentals are just single-family homes. They're not. I mean, we buy, multifamily projects, but instead of doing long-term rents, we convert them into short-term rents so we can max out that cash flow. Even, run down motels or hotels that we would convert into a boutique hotel, and we typically, by doing the ARV, we can increase 2, 3, sometimes 4 or 5x on the cash flow side of that.
So what I'm learning here, what I'm hearing here from you, is that you want to make sure that a property, that if you go into a short-term rental investment, and it could be different types of those, but you're always looking for the cash flow first, then the appreciation, then the tax benefits, correct?
That is correct. And it's always the rule of threes in real estate investing, in my opinion. It's, on the front end, I'm looking for location, I'm looking for proximity, and then I'm looking for views. And I'm looking at both of those in commercial and also in short-term rentals or even multifamily. And I learned this, all the way back in the early 2000s. My business partner, Reg Booth, and myself built a glow-in-the-dark miniature golf business around the country in shopping malls. And the first 10 that I deployed, David, we were renting or leasing the crappiest space in the corner by Sears because we could get it with no long-term lease and at $2,000 a month. But I didn't have the location. I didn't have the proximity to the internal traffic driver, the movie theater, the food court, and nobody could view us. I had no view. Nobody could see. So nobody was coming to that end of the shopping mall. And we applied those same concepts. And I'm like, Reg, how do we do this? Because he had like 200 Pizza Huts, and it was all based on location and proximity to traffic. He's all, because I let you cut your teeth, and we made a $500,000 lesson for you. Now let's go ramp up. And in about 6 years, we'd grown to about 178 of them nationwide, but we were buying location traffic more than anything else. I don't think a lot of people, when they're really making, unless you're a really sound real estate investor, as we talked about, you have all classes of it, right? I have all classes of it. I'm always looking for the traffic driver in that location and proximity to it first, right? It's one thing to be next to Disneyland in Los Angeles, but if you have to get on the other side of the 91 freeway and then navigate into the parking lot, it's different than being across the street. You might have the same location, but the proximity and the access is different. So most passive investors that aren't willing to take those 2 extra steps and put in that extra work are the ones that have not made as sound of investments in 21 or 22, and they're getting bit right now because they bought at the height of the market and they didn't understand the fundamentals that go in, to maxing out that revenue.
That's an interesting, not interesting, it's a great perspective. So from my perspective on a short-term rental, so we do, as a tax strategy, we like to talk about the short-term rental loophole and the cost segregation and depreciation. But I take a totally different approach than telling somebody to go buy a property at Disney or on a lake or a cabin or something. See, I mean, high-income earners, typically W-2 earners, benefit from the short-term rental loophole. It sounds like you're aware of that because that's something you just mentioned. So,
right.
When they come to me and they want to take advantage of it, that's not necessarily, the first thing I'll say is, like, first off, short-term rentals, it's a business. And I don't know if you have the time, energy, bandwidth, whatever that may be, to be able to manage this thing. Is probably not something you want to do. And I'll tell them, because the only way that they could benefit from the tax savings is if they manage it themselves.
They have to have material participation. You're right, 100%.
Correct. So, I mean, they could be investors, but then that wouldn't get them the tax benefits. They would just be buying a property at this point. But if they want the tax benefits, they have to manage it. And I always tell them, look, do you want to be the person that responds to the text message at, 1 a.m. saying, hey, what's the Wi-Fi password? Right? Like, that's going to come if you have to materially manage it yourself. So I said, what would be better is if you want to benefit from the loophole, then what we need to do is we need to look for a long-term rental property, a long-term or a midterm, whatever your preference is, right? Long-term or midterm, that you could use as a short-term rental in the year that we're in. So, like, right now we're in 23, you would use it for a short-term rental for the year of 23. And in 24, you could use a long-term, midterm, whatever you want, because we qualified for the short-term rental loophole. But I always tell them the investment though it has to get a return. If it doesn't make sense from a long-term rental standpoint when you're buying it, then you shouldn't do it at all. Like, it doesn't make sense to buy the property if it doesn't give you a return. So I think it's a little interesting that you're saying it, because you're saying it exactly right. Very many people are getting into the game of short-term rentals just for the tax loophole, but they're not making any money. And that, like you're saying, they're coming up short. I don't teach people to get into the game of short-term rentals for the long haul. I told them this is just the shortcut to get to the cost seg, but it has to make financial sense, because if it doesn't, this is a stupid investment. I mean, it's stupid. And there are a lot of people out there teaching it as just a strategy without giving them the full context of the back end of the strategy, because there is a lot more to it. I mean, in your case, by the way, I think it's favorable if there are a lot more people doing this, because you're probably scooping up properties.
That's what I mean. That's what we're buying right now, to be honest with you. I mean, right now, I've been in real estate since 1992. I literally bought my first duplex when I was 19 playing professional golf in Bakersfield, California.
That's awesome.
I've never seen the market shift the way that it has right now, outside of, the implosion in November, December of 08 moving into 09. I don't think that's going to happen right now, just because we just don't have enough inventory. But I think over the next 5 to 6 months, we're going to see the best buying season, if you're in a financial position to buy, that we've ever seen outside of the Great Recession and the crash. I just closed on a property a week ago. I've got multiple others all across the country that are under contract now, and I'm always looking for the best deal. And I think, as you probably see, David, what you mentioned is 100% correct. And it's probably the biggest thing to where people get pissed off at me when they call, or I put out a reel on Instagram or send out an email, and they're like, we only want to buy for the tax benefit. Well, that's not a strategy that's going to have long-term benefit. And it's usually those high-income, hard educated, the professionals that are trying to get into it, that are making $500,000 or more, and they just want to get $100,000 dollar for dollar write-off. I get it. And that's kind of when I talked earlier, my mission as a father, as a husband, as an investor, is to teach people how to invest the right way, right? And there's a reason I put on the largest conference in this industry. And I don't know if you have a conference. One, it's extremely time consuming. It takes me a year to prepare for a 3,000 person conference. And two, it's going to cost me close to $2 million to put this thing on, which is crazy risky, especially in this climate. But I want to increase that reach, to have that message, to do it the right way. You obviously understand, and you're an expert in the tax side of the business. And I'm sure you see that as much as I do, that people just want to get that accelerated depreciation benefit, and they're not thinking how that affects them. Then the double whammy, I'm sure you've had to unwind some of this as I have. I'm doing the cost seg. I buy a property and I'm going to get a DSCR loan with a 3-year or 5-year prepayment penalty. Then it doesn't cash flow in year number 2 or year number 3, and I want to sell it. Now you're screwed because you're recapture on the tax side and you got prepayment penalties on the DSCR side.
There are a lot of, people out there teaching the strategy because they learned it on some TikTok video, and they're teaching it to others, and they're selling it as advice. And, I can't tell you how many clients come to me when they're upside down on a deal. I mean, this is like almost every day. I'm losing $1,500 a month on this one. I'm losing $800 a month on this one. I'm like, why would you have done this deal? Oh, some guy told me that it's a good idea to buy a property in like some other state and manage it. You get the tax benefits. And I said, was he like selling properties? Like, yeah, he sold it to me. I'm supposed to be negative for the first 2 years because that's just normal. And we're supposed to somehow get an increase in rent in 2.5 years magically, and we'll be even at that point. I'm like, oh my God, like you're supposed to vet the deal. I always tell the ROI is the number one thing you look at. Screw every tax benefit. It's like letting the tax tail, you can't, the tail wag the dog. You know what I'm saying? Like, it's dumb. And I think you're teaching it right, man. By the way, you said about your conference. Tell us about this conference. I want to know about it.
It's the STR Wealth Conference. It is, we'll have 3,000 people, attendees. It's February 5th through the 8th in downtown Nashville, Tennessee. It'll be our 3rd year. Damon John is one of our keynotes. A gentleman you probably know, Hank Norman. We haven't announced this. Hank's coming in to speak. Pace Morby, creative financing. I'm sure you know Sean Makey. I'm going to have Sean here. It's incredible. So I was in a music venue the first 2 years, which capped out at 1,000. Don't tell the fire marshal, but I think we had 1,100 each year, and we sell out usually in about 2 months.
Wow.
It's kind of like 10X with Grant, right? It's rock show to keep everybody entertained, high energy, but just the best of the best from, an educational standpoint. And I'm excited to go from 1,000, 1,100 people to 3,000 this year. So we have a huge investment in a big venue, and it's going to be pretty awesome.
That's freaking amazing, man. Yeah, I actually put on a conference every year, and we're planning our next one right now. And I would tell you, man, you doing that's huge, man. That's a lot of energy and work. So what are they going to get out of this? If I went to the conference, what would I get out of it?
Absolutely everything. I mean, from where to start. So we have a whole track for new investors on how to get started the right way, and you said to treat it like a business. So this isn't like, I don't take on sponsors just to take on sponsors. The sponsors are people who me and Mike Sjogren, who is my partner in the event, that we vet, that we use. We're very selective. Same with our speakers and our educators. And, like personal brand is an example. Very few people know how to really build a personal brand. And you and I both know there's nobody better at that than Hank Norman. So that's why I'm bringing Hank in to come and talk about that. And we bring in the best attorneys. We bring in the best financiers, the best banks, the best insurance, and kind of hit all levels that go from single-family short-term rental homes and vacation rental markets to urban areas. Like you said, that there's no question, David, the number one skill that somebody has to have if they're going to get into real estate in any form or fashion, industrial warehouse space, local retail, commercial, midterm, long-term, short-term rental, multifamily, you have to learn how to underwrite. That's the most important thing. So like my super team, we have a 15 tab pro forma, what we call the big daddy, that we teach people how to utilize. Don't use these BS online calculators like, you're not going to get your debt service coverage ratio factored into that. And you're not going to get your good, better, and best scenario. And I think the biggest message, the theme of this conference at a sub level for me is we've already talked about, not investing strictly for the tax benefits, but do not buy a piece of property, land, apartment, single family home today, banking on repositioning, in 18 to 24 months with a rate drop to go from 8 that you're paying today down to 5. Because we don't know that that's going to happen. It has to underwrite at today's terms that you are able to get. So if you today, it's cash flow, then appreciation, then tax benefit, then reposition. That's just the icing on the cake. And I'm sure you see it too. It blows my mind. Oh, well, hey, I'm okay losing $1,000 a month right now on this $700,000 property, because when I can reposition to 5 from my 11% DSCR product or my 8% commercial loan or my 7.5 Fannie and Freddie, then I'm going to be cash flow positive. Well, if you can't underwrite it today, don't make the deal. So for us, I'm the no bullshit guy that's telling you the freaking truth. And that's everybody that's going to be at that conference is not, well, one, it's a no selling zone. It's not a pitch fest like other conferences, right? It's a comfortable space to be able to come and have fun, network, and be around people that are doing it the right way.
Amen to that. It's so funny, but I always see that crap where people are just sold into deals and they're told all these things. I like that you're taking the approach of the cash flow first, and that is important to me. I think every investment I've ever made, I've always considered, am I going to get my return or not? I mean, I don't think about the tax. The tax is my secondary for me. I like the appreciation, but to me, I'm thinking cash flow than the tax. So we got a little different there, but it's the same outcome. We got to make money or this does not make any sense. It just does
the
not
other
make
thing,
sense.
David, you probably see it, is just the reckless use of 1031 exchanges. And, especially when you look at people that are younger than us. And I think back, I didn't do my first 1031 exchange till I was 46, right? And I was in a financial position to be able to basically burn the $100 bills, if I wasn't ever going to touch that money again. And I think there needs to be this financial and tax literacy in real estate investing to understand that if you do a cost seg and a DSCR product to acquire something, it's okay, and a 1031, but you better have a plan for that. So kind of back to the beginning of the podcast, that's where I look at that whole plan in detail. If you're going to be a real estate investor, don't just think that you can do a 1031 and then roll that into another 1031 and then do the poor man's 1031 and cost seg to offset some of the taxes. And, you make $100,000 on your basis or your 1031 that, and then you make another 200 in your next deal, and you're investing well. Now you got 300 in a basis, and you put it into the deal 3, and you've done a cost seg or 2. Imagine you'll never touch that money again. That's Uncle Sam's money that you're playing with, right? So that really, you're either going to give it to Uncle Sam or you're going to give it to your kids when you die. That's what I call you're either going to pay Uncle Sam or you're going to pay coffin tax, one of the two. And because you will never see that cash again. And I think there's way too many people that are not in a financial position behind their investments, cash-wise, liquidity-wise, to be able to do that, and they don't understand.
I 100% agree with you. I think 1031s, it's so funny, but we do these quarterly boot camps about real estate, and we teach a lot about just different strategies from a tax perspective, how to approach real estate, what to consider, what are you thinking about, you know, the 1031s, you know, the cost seg, the way it's structured. Like there's just a lot of angles. And the number one topic we always get is I'm on a 1031. And I remember on our June boot camp, for some reason, 1031 was the hottest topic. We talked about 1031s, interesting enough, probably for 3 hours. I have no freaking clue why we're talking about 1031s for 3 hours, and I know we could, but everybody was like, well, I want a 1031, but what are the consequences? I'm like, well, look, 1031s are good. Push it forward if you can. But be strategic about it, because if you're going to do it in year 2 of owning the property, you just did a freaking cost seg. You know, it kind of defeats the purpose of doing a 1031. You're going to pay taxes no matter what. You might as well, you know, my philosophy is I'm going to keep everything as long as it's making me money. I mean, if the goal, that's me personally, I just don't want to need to sell anything. I don't need to. I make more money every year than ever did. I don't need to sell anything. And if I ever did, and it was such a big project, I'll find a way to leverage something. But I don't need to sell it. I think we just keep it. I mean, until I need to refinance it.
Right.
Because I'm going to take my cash out, because I'm not going to leave it cash free. That's for sure. But I mean, there's so many structures in real estate. I actually think you're doing something, in my opinion, is noble. I think it's such a great thing what you're doing to helping people. So they can come to this conference. You said it's in February?
February 5th through the 8th. It's strwealthconference.com. Tickets are on sale now. And
we're going to put it in the link of the description of this video on YouTube so people can go and check it out. I mean, I personally want to go now too. If you're going to have that many people and great speakers, I'd love to be part of that somehow.
We would love to have you.
Yeah, we could definitely promote this. So there's the concept of STR that you focus on. Is there any other strategies that you teach? I know we're talking about STR as a wealth strategy. What other things do you push onto your students or share with your students?
So, I mean, it's kind of ironic that, I mean, I have a little bit different strategy probably than you do when you talk about leverage. I'm sure are you familiar with Mike Michalowicz? Profit First?
I've seen that. I've never read that book, but I've seen it.
So I had Mike as my keynote last year, and he wrote Profit First, which he's probably more famous for here. But what's interesting is Mike was the most dynamic keynote that I've ever seen in my life. And the guy that showed up like 4 hours ahead of time and stayed 4 hours later with my VIPs and all that type of stuff. I got back to the hotel and he was still doing stuff at 11 o'clock at night. We started talking about how I manage my real estate portfolio. So you talked about work. I followed this plan, but I'd never read the book. And it's kind of funny. So I trim my smaller properties, right? And I do I always do cash on equity audits because I don't want to have a gazillion properties. I don't want $100 million worth of real estate. I want to generate my cash flow and have about 20 million bucks that I can leave for my 2 daughters. And they don't need 100 million. So right now I've got like $18.8 million just in my short-term rental portfolio, but I've only got $3.7 million in debt today. Right. And so I net last year $997,000 in net income, but I just bought a property for $950,000. So really that 3.7 now is whatever, like let's call it 7 million, 4.6 million. I can't pay that off in line with my youngest daughter graduating from high school. She's a freshman, unless I increase my EBITDA, increase my net income by about 10 to 13%. So my goal is to hit my financial goals with the least amount of real estate, the least amount of properties, right? And the least amount of time invested. So I pumpkin planned for about the last 8-9 years of doing cash on equity audits. And if I'm not getting a return that I could get by making a new investment, so if I can get an IRR, let's say a cash on cash, because that's easier for people to understand, in 4 years, but my existing cash flows at 8 years, I'm going to sell, and then I'm going to move forward and reinvest that into the 4 years. Well, a lot of people say, well, why don't you just cash out refi? Why don't you HELOC? Why don't you access that cash and leverage? Because when I was younger at 30, I was following Robert Kiyosaki. I was rich dad, poor dad. I'm 50. I grew up with my grandfather as my father figure. I didn't have a dad. He grew up in the Great Depression. I want to be debt-free. So now I've got literally just under $5 million in debt, that just my short-term rental income, not my coaching income, not my other business, I have 7 total businesses right now, just that real estate income will pay off the debt if I make no more moves. And if my cash flow stays the same, I should be just under about $1.1 million a year in cash flow. So I kind of take my strategies a little bit different. And that's why I think one of the big things for me is I have that desired outcome that I've architected. And that's what I run through with like a student when I'm teaching them. I have to know that. It's what I call knowing and being known, or I really can't give advice. So where do they want to be? How adverse are you? Are you Dave Ramsey, Robert Kiyosaki? For me, I'm probably right in the middle, slightly moving towards Dave Ramsey as I get older. Just based on the way that I was brought up. Could I make more money? Could I acquire more real estate? Absolutely. But for me, time is the most valuable currency, right? And you talked about short-term rentals are not passive. I get the IRS classifies them as passive. I used to spend during the time that everybody got in during COVID about 5 to 7 hours a week on 28 properties. It was completely passive at that time. Today, I'm probably doing triple that to sustain the income. So I'm doing like 20 hours, 25 hours on a weekly basis that I'm having to put into it to sustain. I've got to do the marketing. I got to do listing optimization, all those types of things. I enjoy it. I love it. I'm not complaining. It's still not a full 40-hour work week by any means, but I'm trying to get smaller and smaller, but still increase or sustain the cash flow by implementing Mike Michalowicz's pumpkin plan.
That makes a lot of sense, by the way. I like the idea. And by the way, it is a seasonal thing in life, right? We take a lot of risk when we're young with probably a little bit of money. And then as we age, it's a little bit of risk with a lot of bit of money, right? Like you kind of change it around. And by the way, I could see that. So I don't think that our strategies are any different. I think it's just the season, right? And it makes a lot of sense to me to see that you're going to be out in cash flow. And I like how you're tying that down to your daughter. That's a very cool thought process. Like I want to have it tied out with her, I guess I'm assuming college, graduation of college.
Yeah. So, I mean, that's that whole plan, that creating that super life, right? I don't know where my youngest daughter is going to go. My oldest daughter just got accepted a couple of weeks ago and is staying in Nashville and going to Belmont University. That's another thing about the planning part. I mean, I've been doing 529s, all that type of stuff, saving for them since my oldest daughter was born. But I didn't think I was going to spend $60,000 a year, on an undergrad education at Belmont. I was thinking maybe 25. So that's a life.
Well, I hope she could be a doctor or something, man. Come on.
She is going into the medical field. So there's going to be another $500,000 in medical school after that, but she's paying her own medical school. So my youngest daughter in that life plan, that's those life levers that have to be pulled, right? So a lot of people don't factor into, are you going to have to take care of one of your parents? I had to take care of my mother for 3 years before she passed away. And I had to put her into an assisted care facility. She thought she was broke. I had to pay for it. It was $8,800 a month, probably close to $10,000 a month after, Ubers and time and getting groceries and all that type of stuff. I was not in the financial position at the time to be able to do that. The interesting part, David, she left me like $1.1 million. She was rich when she died.
Wow.
She had plenty of money. She didn't know it because she lived her life so frugal based from her father, my grandfather, who really is the impetus for me to want to be debt-free. She had no debt, zero. And those life events are things that fall into that plan. When you have a successful business plan, you're forecasting more than just revenue, right? You're forecasting when you have to add on an FTE, that's a full-time employee, or buy another vehicle if you own a motor coach company, or expand your coffee shop to the location next door into a second location. But we don't apply those same thought processes to our life. And that's what I learned from John, to apply those to my life. So yes, you're right. I am making my real estate strategies and the timing, that forecast, to pay down the debt to coincide with when she graduates, because me and my wife, essentially we're retired now. We just want to travel more. The other thing that we just found out, we bought our dream lifestyle asset in Montana in February, and our youngest daughter made her high school soccer team, so she couldn't go with us for 2 weeks. So I took my in-laws, my oldest daughter, my wife, and it was the most epic 2.5 weeks we've spent on vacation anywhere. We love Montana. But we came back and we sat down, and my oldest daughter told my youngest daughter how great the vacation was. We've got beach houses, we've got lake houses, we've got shit everywhere. And we had a really serious discussion with them, and we said, which one do you guys love the most? Which one would you guys want to live at if you had to choose? And what we're trying to dig out of them is which one feels like home to them. Because in our plan, my wife and I were going to sell this monstrosity of a house that we live in. I mean, it's 7,000 square feet. No, a couple doesn't need 7,000 square feet, right? So we'll sell that. We've been in this house for 18 years, take the $2 million in equity, redeploy that wherever. But that all changed. They're like, we don't like any of the houses. We like our house. They don't want to go anywhere. They don't want to go to the beach and be on the beachfront. They don't want to go to Montana. They don't want to go to our lake house. They love here because that's where they grew up. So my wife and I had to change our plan of selling this house. And now we've decided, you know what? We're going to live in this house till we die. And we'll put a couple $100,000 into the backyard and a fire pit and a pool and all the stuff to where they're going to want to come back during and after college, because now we're competing with whoever they marry.
That's right.
We got to have the cooler house and the cooler parents to where our daughters want to bring their husbands and their kids back here. We got to win Christmas, David. So that changed everything in our plan to where now we had to restructure, not financially, but on the personal side, because everything revolves around those two young girls.
Yeah, and I can only imagine so I don't have children, full disclaimer. However, if I had two young daughters or daughters in general, oh my gosh, man, they would make me do whatever they wanted in life would be at my deliver, right? I got to do this, right? That's gotta be very humbling to a man when he becomes kind of, I can't say a slave, because that's kind of how I feel like I'd be, but humbled. So that's got to feel great, by the way.
Well, here's what I'll tell you, David. The estrogen is high in this house. I've got a wife. I've got two daughters. I've got two female dogs and a female cat. So I'm the lone testosterone in the house.
You need some TRT, man.
Exactly.
Oh, man. Well, this has been fun, man. I've learned a lot about you. I think, if anybody's out there watching this and they're like, man, I thought about short-term rentals differently. I do too, by the way. Now I'm seeing what you're doing. I always tell people personally, I'm like, man, I like short-term rentals. I think they're cool, but I personally don't want to manage them. Now, I do understand that there are companies out there that can do it, and there are people who can manage it for you. What is that your opinion on it? Like, what is your opinion on the management side? Is it all managed by you? Do you have a bunch of property management companies? Is it regional? Is it house specific? How do you do that? So
I self-manage all of my own properties, and I have technology in place to where I've got about 85 to 90% of it automated. I even own a business is called, strvas.com. So we train VAs, virtual assistants, on how to do this stuff. Everything from marketing. I own the all-in-one marketing platform in the industry, Market My STR. Teach them on that, guest communication, all that stuff. I don't operate that way. I don't have a VA that helps me. I manage my own properties. My wife helps a little bit when I'm flying and I don't have Wi-Fi or something like that, but that's it. I also own a co-hosting company, which is, kind of like a management company. And I don't use anybody else there either. That's just me. So you can automate this business to a good 85 to 90%. If you want to use virtual assistants, you can do it 100%. There's no question. They'll do the research. They can handle your marketing, your listing, your guest communication. They can communicate with your cleaners, your handymen, whatever. And I know a lot of people to do that, but I'm kind of at the top with building super properties. And because I'm that discerning traveler, I'm the guy that doesn't stay in short-term rentals because there's such a lack of consistency, right? You never know what you're going to get. That's going to end up being the industry's demise. It's not going to be the real estate markets that we can't compete with Marriott's consistency, right? Because all the individual owners and the different cleaners and the lack of systems and process, all that type of stuff. That's the risk in the short-term rental space. So mine is systemized, even though I've got different cleaning crews in Smith Lake versus Gulf Shores versus North Carolina or Montana. We've tried to systemize everything, and the same linens, the same coffee makers, the same everything goes into it, the same Schlage code locks, the same Ecobee thermostats. Everything is identical. And I learned this when we were going from those first 8 of those 10 first Glow Golfs I told you about in 2003 failed, right? I had to figure that shit out and get those systems nailed and how to negotiate and underwrite shopping malls before we could expand. Then we were opening 30 to 50 locations. It seemed like a year after that. That's almost one every 10 to 14 days. And so we systemized that, and then kind of making those same things applicable. I'm on a mission because I loathe property management companies. They are not there to make you more money. They're there to suck your profit, out of your bank account because they don't do shit for you. They're not running Facebook ads. They're not doing pricing strategies. They're not doing listing optimization. Any of the shit that really matters, they're reactive versus being proactive for you as the owner. So if you do want to be 100% passive, like not even self-manage and use virtual assistants, then get a co-host. And they're easy to find specifically online, and they are transparent. You own your listing. You get paid first. Then you pay them on invoice. Property management companies, they own your listings, which means you're dead in the water if they don't perform and you want to fire them. The owner should always own all of our assets. There's transparency with co-hosts, right? Legally, they can't go in and escrow your dollars and then pay you back. You have to be licensed and all that type of stuff. So, but at the end of the day, if you want to max out the profit like I do, take full advantage of the tax benefits that David and I have been talking about today, you have to self-manage. You can't use a co-host and you cannot use a property management company because you have to be the person that puts in that 100 hours for material participation per property and be the one to work the most in your property. And you can't do that, with somebody else managing. You can beat the cleaners, right? You can track their check-in, check-out on your Schlage locks or an app or whatever if you ever get audited. But beating somebody that's going to manage for you is going to be very challenging. Even myself, David, I qualify under the 500-hour rule in material participation. I still wouldn't be able to do that if I had somebody managing all of my properties for me.
Yeah, you said you did about 20 hours a week. So, I mean, you're very close, but not close enough, right? I mean,
Yep.
You would need to do more. Interesting, man.
Well, my wife is probably give full perspective. My wife probably does 5 to 8. Let's just say it's probably 30 because we can combine our hours, right, for material. So it's probably 30 hours. We're probably like 1,500 hours roughly, on an annualized basis.
That's really good. I'm assuming you group them together so you can get the grouping election. Is that how you do it?
That is correct, yes.
Yeah. See, you guys are doing it right. Very few people, if you're watching this, very few people know how to do it right. Bill knows what he's doing, guys. If you guys are interested in learning more about short-term rental investing or taking your short-term rental that you currently have and maximizing that thing, because maybe you are one of those people who bought one thinking it was cool and you're stuck, this guy might be able to help you, I think. So, Bill, how can somebody contact you if they'd like to work with you?
I've got buildshorttermrentalwealth.com, and I've got 30,000 people plus, I don't even know the number, in my Facebook group. Free to join. Tremendous community that happens in there. BillFaeth.com is my personal website, and then BillFaeth73, as you can see down below here if you're watching on YouTube, on my Instagram. But pretty much I'm on TikTok, Instagram, Facebook, everywhere.
Hey, man, you're doing some big things. I'm looking forward to going to your conference. It sounds like you've got some big things and some big people. Guys, if you want to get there, we'll have that link also below for you to grab a ticket and get to this awesome event and work with Bill. Bill, any final remarks, anything you want to share with the audience before we go?
Man, I just really appreciate you having me on your podcast, David. I appreciate what you do. And those of you that are out there, I mean, I pride myself on being the most accessible, honest, and upfront. So if you're struggling, like David said, you made an investment that may not be cash flowing, you need some help and some guidance, just DM me on Instagram, BillFaeth73, that's Faeth. I'm more than happy to help you, for free.
I genuinely believe that, man. So I'm looking forward to working with you in the future as well. Maybe I'll decide to get into short terms now, and maybe I'm going to do it, man. I've been wanting to buy a condo on the beach for a while, so it is something to do, man. Well, I appreciate your time today, and I'm wishing you much success, my man.
Awesome. Thank you, David.